Perfect.
Oh, you've done it. We're live. So you can share your screen there if you wish, Thomas, and we can kind of just
perfect.
Pause until give anybody who's a little bit.
Hello to anyone who's watching at the moment. We'll get cracking in a couple of minutes here. Let's leave another couple of minutes before we kick off.
I should I'll open up the YouTube channel because people can add questions on YouTube if they want.
Super, yeah.
So if we have time, we'll take a few questions towards the end. Okay, you're all very welcome along to the Around Finance, the second Around Finance webinar, which is today looking at all things in relation to e-commerce, and particularly where e-commerce meets marketing, meets finances. So I'd like to introduce you today to Thomas from StoreHero. And Thomas, if you want to just give us a short introduction and we can kick off from there.
Perfect. Thanks very much, Richie. Really looking forward to this today. My name is Thomas Gleason. I'm a co-founder at StoreHero.ai. StoreHero is a SaaS platform for D2C brands and agencies, really to centralize all of the, not just your Shopify or your WooCommerce data, but we also bring in all of your marketing data. So all of your paid marketing, Google Analytics, email marketing, and then we're also trying to bring in your variable costs, so shipping costs, 3PL costs, transaction fees, and general operational expenses as well, to try and get as close as possible to understanding those core unit economics, margins, and profitability of your business. Just a bit of background on myself, I suppose. I grew up with e-commerce at home. My mom's had an e-commerce business for nearly 20 years. Worked at Shopify for 3.5 years and left nearly a year ago to set up StoreHero. So yeah, we're an Irish-based company, as you can probably hear. So things are moving well, and really looking forward to kicking off the webinar today.
My name is Richie Lennon. I'm an accountant here at Around Finance. I'm the accountant and owner and practice owner of Around Finance. So just a quick introduction to myself. I've run the practice for the last 10 years. I've also done a lot of work with the local enterprise offices, Enterprise Ireland, facilitating New Frontiers programs in a number of different innovation centres around Ireland. So in terms of the clients, I've also had CFO positions in a number of different organizations, one of which is Convara Skincare, which has given me a good understanding of what it looks like to sell product in both the retail and online environment. So the types of clients that we work with these days, it tends to be either e-commerce or retail oriented businesses, marketeers and professional services businesses, or the odd tech startup, which comes from my days working with Enterprise Ireland. But today's focus is going to be on this e-commerce space, and there's been a lot of change in the last 12 to 18 months in terms of the shifting landscape of what it is like to be successful online. And I met Thomas, I'd say, within the last 6 or 7 months. And to me, working in this space as an accountant for the last number of years, I've met quite a lot of marketeers, and Thomas is one of those rare breed of marketeers who understands product brand, but also understands finances. And so today's conversation is going to be that bridge between how to be successful online and how to be informed by the numbers in doing so. So with that said, we'll kick off. And once again, thank you all very much. We're live on YouTube, so if you have any questions, feel free to post them in the chat channel, and we'll do our best to take whatever questions arise along the way. So thank you very much, Thomas. Over to you.
Thanks very much. Okay, so we are at the 6th of October, 49 days to Black Friday. Obviously, we're coming into a busy time of the year for everyone operating in the e-com industry. So just to kind of kick things off, I suppose we look at Black Friday 2022. $11.3 billion generated. So Black Friday 2022 versus 2021, up 4%. November in general was up 8.7%. Busiest time of the year, busiest time of the weekend, I suppose, over the BFCM weekend. Surprisingly, actually, I actually thought it would have been on Black Friday itself, but 8 p.m. on Cyber Monday tends to be the busiest time of the weekend. So people are looking for those last minute bargains or deals before that kind of sale window starts to close. And 77% of purchases last year happened on mobile devices. So just kind of what you touched on there, Richie, I suppose. And yes, an awful lot definitely has changed in e-commerce over the last couple of years. And I suppose what has driven that change? It definitely increased competition. E-commerce has got harder in general. I think COVID was great in that there was a bit of an e-com boom, but it also meant that loads of new retailers who previously weren't online came online for the first time. And that I suppose COVID was a bit of a false sense of security in a lot of ways for a lot of brands, because you kind of came online at probably the Helicon days of e-com, where the optimum macro conditions were there. I mean, you had all of the physical shops actually closed. Everybody had lots of money. Everybody was also on their phones and on their devices all of the time, which meant that all of the ad space that was available was actually very, very, very cheap. Obviously, since COVID has kind of subsided, we've had attribution issues. So Apple launched the iOS 14 update, I think it was May or June of 2021. That just meant that your Facebook ads tracking and your Google ads tracking got a hell of a lot tougher, which meant it was harder to kind of start to target people. And as a result of all the variable conditions I've kind of just mentioned, the targeting and the cost of the ads actually got a lot more expensive. I think it's been no secret over the last couple of years, particularly the last 18 months, inflation has definitely hit everybody. Poorer purchasing power for the consumer has definitely hit e-com and retail in general as well. Just reading a report last week that Shopify would have released, and I think they said that the cost of ads across Facebook and Google has kind of increased by about 30% over the last 18 months, which is obviously quite interesting. Yeah, really, really interesting. I mean, still definitely two really, really profitable channels, but I think that the days of easy ROAS that we were all kind of getting used to, unfortunately, have probably subsided. And I know, Rich, you were kind of touching on the growth of the marketplaces in something kind of in this context as well.
Yeah, what I'm seeing is, you mentioned the glorious days of maybe 5 years ago, whereby, from what I could see, you didn't have to be because the ROAS was so good, you didn't necessarily have to pay as much attention to the finances, because it was every night was a winning night at the casino. No matter what you put into the machine, you were going to get 4 apples. You could just put in a tenner and get 100 quid back, and away you go again. And for me, that day is no longer, and it's not going to come back. There's a couple of things that people should be aware of as well. Is clearly the Facebook audience is starting to age out a little bit. So people are having to shift into different marketplaces to try and get return on their advertising spend. And in addition to that, the growth of marketplaces, obviously, it's a battle for footfall. So trying to get people directly to your website by only investing in Facebook and Google, whilst Facebook and Google are the ways to get people to your website, it's a tougher environment. And from my perspective, it's not that you can't be successful online. It's just that it's required to be more focused on return on ad spend in different spaces. So yeah, that's exactly what I'm seeing as well.
100%. Just to kind of add to that as well, it's definitely not that you can't be successful. You absolutely can. But the brands that are going to really survive and thrive the next couple of years are going to be the ones that, I suppose, have that connection between their marketing and their finance departments. Like in the past, those two functions could operate in completely different silos. The marketers were really good at their job. Finance people were really good at their job, but the two didn't really actually need to understand each other too well, and you could have actually had a really profitable business at the end of the day. But I think just from what we've seen with some of the larger brands, those two functions in the business, the marketers can really speak finance without needing to become accountants, and the accountants or the finance teams in those larger businesses that are really doing well, they understand the marketing acronyms. Because if you're relying on your financial advice from, we'll say, a typical accountant, you may be their only e-commerce client, and therefore if you're getting financial advice from that person who doesn't necessarily understand terms like ROAS or conversion rates or average order value, you end up actually essentially taking a financial advice on how to run your business for somebody who actually doesn't really understand the intricacies of it all, which is quite interesting. And I suppose that's kind of how even StoreHero came about from my side, in that my mom has had an e-commerce business, wowee.ie, for nearly 20 years. My dad was an accountant, and I actually found myself piggy in the middle to some extent, operating on spreadsheets for years, trying to explain accounting to some degree to my mom, and definitely trying to explain marketing a little bit tougher to my dad. And therefore, we kind of built StoreHero as a platform to try and bring those two functions, I suppose, in a bit more unison.
Yeah, I just add that, Thomas, I think the product StoreHero, we'll touch on it later on. I think it's great for that reason. I think for me, again, as I mentioned before, just spending ads is not going to lead to success in an e-commerce environment anymore. And the fundamentals of business apply, and that means understanding your customer, understanding your brand. So the people that are going to be successful in an e-commerce environment are those that are building the fundamental building blocks of their business in a old-fashioned business sense, whereby they understand their customer, build a great product, and then bring in the marketing and start to understand what's profitable. So if you are understand your business in a proper nuts and bolts fashion, it is the case that there are businesses out there succeeding very much still online. But with that said, let's focus on the next one, Thomas.
Cool. And even just, I suppose, touching back to the title of the webinar, how to grow your e-commerce business. It's understanding, I suppose, really important to understand what do you want to grow. That might sound like a silly thing to say, but are you trying to grow your sales or are you trying to grow your profitability? There can be a bit of a misconception that you need higher sales to drive higher profitability. Obviously, that is the case a lot of the time, but it's definitely not always the case. You can often run, and we're seeing this with a lot of brands, you could actually maintain your sales levels or even decrease your sales levels to achieve a higher profitability if you can get some more pieces of the business in line, which we're going to touch on here. I suppose if you're looking to typically just grow sales, you're going to need a lot of money to just spend aggressively. Your main focus is going to be continuously on new customer acquisition. A lot of the time you can afford to lose money on getting new customers in the door. For instance, if you are, this obviously depends on the brand and the nature of the brand and the industry that you're operating in. But for instance, if you sell, I don't know, coffee or toothpaste, there's going to be a largely high returning customer rate on that customer. Whereas if you sell a sofa, they're not coming back once a month, unless it's a terrible sofa, to buy a new sofa from you, you know? So for instance, if you were trying to sell toothpaste or coffee, it actually mightn't make sense for you to try and be profitable on acquiring that customer first time. If, for instance, you are confident in the data that you have and you know that customer comes back on average once a month, and say, for instance, you know that you can be, it's going to cost you €30 to acquire that customer, but you only make €10, let's say, gross profit on your first order. It's actually, you're not going to be profitable until after month 3 on acquiring that customer. But if you were trying to be profitable on your first order, you won't be able to spend as much or acquire as many customers, and it'll just really hurt the profitability of the business in the long run, I suppose. It also does make sense for some brands, for instance, if they're trying to enter new markets, if they're trying to launch a new product range, you can't expect to be profitable all the time in new markets with new product ranges. So there is a case in point whereby you are spending strategically to lose money, as weird as that sounds, but you have your data backed up that in the long run, you know, this is going to come back to you in more ways. Second point there, I suppose, is looking at profitability mode. This is the case, I suppose, with most of the businesses that we're working with. They're really just trying to, I suppose, right the ship and just trying to, I suppose, lean out things and just make the business a lot more profitable. So I suppose the first thing there is looking at margin innovation. What does that mean, I suppose? So you're really trying to figure out how do you get more margin out of your existing sales that are there? Is it a case that you can renegotiate with your suppliers, your shipping, your transaction fees, fulfillment fees? Even looking at things like discounts. Are you discounting responsibly, strategically? Are you on the opposite side giving 25% out for anyone who signs up with their new email address? Are you giving out a free shipping threshold? How does that stack up relative to your average order value? That's a really, really key piece as well. For instance, if you have an average order value of, say, 50 quid, and then you are given free shipping, if you're shipping with Unpost, it's going to be around the €5 mark. So you've essentially, say, for instance, you're giving a 10% off for welcome 10 if you give over your email. You've then given 10% off, so you have €5 off, and then you've also given a free shipping discount. You're essentially on a 20% sale without even realizing it. So just be really careful with how you're discounting and just making sure that it lines up strategically and that you're testing it. Because a lot of brands can end up leaking a lot of margin through various discounts or promos that they're running. So just make sure, not saying promos are bad, they're absolutely good, but just make sure that you have your numbers backed up and that you're looking at them all through the lens of profitability.
The only other thing I'd add there, Thomas, is also, which you guys facilitate in StoreHero, is to understand which SKUs that you can push. So which SKUs do you have the margin, and also there'll be bundles of SKUs, and maybe you've got gift hampers or wherever that might be. So there will be some product lines whereby you've got more flexibility to give a discount or to bundle into your promotional offers. So, and it's understanding those on a unit economic level, which is very important.
Really, really important. I mean, yeah, that's such a good point as well, because it's there's so much you can do once you start understanding everything from a margin perspective. For instance, if you have a flood of orders coming through the system and it's a really popular product and it looks pretty and so on and so forth, it could be central to your email marketing campaigns, your Facebook ad campaigns, and it could be on the hero image on your homepage, for instance. But is it actually effective from a margin perspective? Is it a bestseller, but it's actually costing you money once you factor in your discounts, your free shipping threshold, transaction fees, 3PL costs, and so on and so forth, to just make sure that you're optimizing even things like your site merchandising and everything else for margin, I suppose, above everything else.
Can I ask a question, Thomas? Sure. Just curious, what are you seeing on the subscriber side of e-commerce in terms of people offering long-term deals so that they will sign up to be a subscriber over a period of time versus the discounting on the initial sale? Is there trends happening there, or what do you think?
Yeah, for sure. I mean, subscribe and save or subscribe campaigns are really, really effective. If you can get the offer right and you can craft it effectively. Again, it really, really depends on the brand. Like subscription brands, it sounds really good, but it doesn't work for every brand. Like, for instance, we have a personalized gifts business at home. Nobody's going to buy a personalized baby gift on a subscribe and save on a monthly basis, that kind of thing. But if you were selling, again, toothpaste, coffee, skincare, they are types of brands or industries that would lend themselves more to subscription. Definitely something to think about if you haven't done so already. And yes, I think definitely trying to incentivize your customers through some kind of discount up front, and potentially looking to stagger that discount depending on the cadence in which the customer is ordering. So for instance, if you wanted to give a 15% off for somebody who orders every 6 months, how do you incentivize that person to kind of increase that cadence to maybe every 3 months or every 1 month or 6 weeks or whatever it is? Do you look to increase the discount from 15 to 20% and so on and so forth? Again, what you're really trying to figure out is what is the customer lifetime value of that customer over the period of a year, 2 years, 3 years, whatever it is.
That's good stuff. Thank you so much, Thomas. I know that we're going to start focusing on something which is my area, which is profitability.
Sure. Yeah, absolutely. Just I suppose into the profitability piece there again, like you're really trying to just make sure that you're increasing your ad spend, but only increasing it in line with profit. So this term called contribution margin, which we're going to come on to in a minute. And just the final point there before we kind of delve a little bit deeper, I suppose, into what contribution margin is and why it's important. Really looking at, I suppose, your OpEx of your business, because you'll quickly figure out if you have an ads problem or if you have a marketing problem or if you actually just have a fixed cost problem. Because I see a lot of brands come to us and they think they have an ads problem, and when you actually plug in all of the operation expenses of the business, the ads actually could be quite effective, but what's really killing it is a really heavy operational expense line at the bottom, whether it's staff costs, software costs, and so on and so forth. So really just making sure that, I think we kind of touched on this before we came on, Richie, we're kind of saying anywhere from 18 to 25% is a good benchmark.
I completely agree. I think so. If you can see that on the if you can see on the unit economics, let's say you're selling it for 20 and you're buying it for 5, wherever that might be. If you have margin and the ads are working, but you're not profitable, it's either the case that you've got a cash flow issue in terms of, or if there's no money in the bank, let's say, it's either the case that you've got a cash flow issue or there's something in the OpEx that's killing the channel. And that can often be things that you just haven't accounted for correctly, such as it can be inside and just the back office expenses. It can be wage costs. It can be renting of the building. It can be anything that's in your operational costs. And what I'm seeing in terms of this more competitive environment for e-commerce businesses is it's squeezing out a lot of the OpEx that might have just crept into the business over a period of time, whereby, again, we were in the happy days of multiple ROAS, and now we're settling back into something which is a bit more challenging. And I don't think that I think if you're looking at that as a guideline in terms of somewhere between 15 and 25, or somewhere in that kind of in and around the 20% mark, I don't think a lot of e-commerce businesses can carry any more than that in operational costs. So if it might be the case that if you're not profitable in your operational channel, but your marketeers are telling you that your ROAS are good and that things are performing in the way that they want them to perform, then it's going to put pressure on operational expenses, which might actually mean wages for some businesses, which you're into difficult conversations at that point.
Sure. Okay, so next up, contribution margin, profit first marketing. What am I talking about? So basically, contribution margin is your net sales. just key on net there. We're stripping VAT straight out. So not what you see in Shopify. We are removing all of the VAT minus your full cost of goods. So not just your product costs, but you also want to factor in your shipping costs, 3PL costs, transaction fees, returns, any of those variable costs that aren't necessarily operational expenses. Okay, so we have our net sales. So your total sales minus your VAT. Now we're stripping out all of the variable costs. So not just product, but that full kind of COGS line. And then we're also stripping out all of your marketing as well. So essentially what contribution margin is really is your profit, let's say, after marketing, but before your operating expenses. So it's important to understand those two different lines. Again, going back to that piece where a lot of brands might have an operational expense problem, or they might have a marketing problem. For instance, if you have good contribution margin, but you're actually not profitable at the end of the day, tendency is that you probably have an OPEX problem. But again, we'll touch on this in a little bit more detail.
I'll only offer just a quick note there is that just in terms of the shipping costs. So what you're going to have inside in your initial COGS is going to be this landed cost. So it lands in the warehouse, so you've got a landed cost, and that's all the cost of importing it if it's coming from overseas. And then you've got this other freight cost, which is the last mile stuff, which is shipping it to your customer. And what you're saying there, Thomas, is that all goes into this expense of before you look at the contribution margin. Is that correct?
Sure. All of those variable shipping costs, so freight in and freight out would be kind of bundled in cost there. Yeah, for sure. Okay, so why focus on contribution margin as a mechanism, I suppose, to gauge the success of your advertising campaigns? We've all been trained to look at ROAS over the last couple of years, and ROAS is still really, really, really important. But I suppose it's becoming more of an important piece to look at rather than the gold standard to look at that a lot of us have been probably trained into doing over the last couple of years. And why is that? Well, I suppose the iOS 14 update from Apple just meant that that attribution piece has got much murkier. I'm sure we're all looking at our Shopify. Some days we could see, I don't know, 5K in sales, and Facebook tell us we've done $3,000, and Google say we've done $3,000. So in theory, we should have $6,000, and we look at Shopify and there could be only 5 there. So I'm sure we're all seeing often double counting. And again, it just undermines your confidence in what Facebook and Google are saying, whereas the contribution margin cannot lie. It's literally, again, your net sales minus COGS minus your total marketing spend across those various channels. So again, it's a good barometer, I suppose, as to have we increased our marketing spend. So say, for instance, we've gone from 3K to 5K marketing spend. Has the absolute number of contribution margin, has that figure risen? Or actually has the increase in marketing spend not been as effective, and has it actually started to dwindle a little bit? We kind of come on to that a little bit in the next slide as well. So again, why to focus on contribution margin? Well, you're really looking at trying to focus on profit, again, instead of trying to just optimize for absolute revenue, which could lead you to a case whereby you're spending more, your revenue goes up, but your actual profit at the end of the day isn't going in the right direction. So you want to try and find that sweet spot. And again, if you can get into the habit of monitoring the contribution margin, it gives you much more confidence and clarity when raising those ad budgets. As an SME, like, it's terrifying to start trying to increase those ad budgets by 30, 40, 50%. But if you have your numbers in line and you're actually looking at them on a profit level, it just gives you much more confidence and clarity to actually start to increase those numbers and just seeing, is it actually working, or do I actually need to start dialing it back again? And once you start understanding this, you'll start really seeing more. It helps you identify where those problems and opportunities in the business might actually be.
And this is particularly important if you're chasing a lifetime value sort of a situation, whereby you gotta spend the money to pick it up on the lifetime value, which could be in month 3 or month 4, as Thomas highlighted earlier on.
Absolutely. Okay, I'm sure a number of you are looking at this slide thinking, what are you talking about? High ROAS equaling lost opportunity. And look, it can. And what I mean by that is I've kind of done out a bit of an example here. So for instance, if you were just trying to, like, we speak to a lot of brands all the time who are trying to achieve X amount of ROAS. And when you really dive into it, it's just because they like the sound of spending 1 and generating 10, but there's no real profit data to back up why they got to that figure. So for instance, we've kind of gone through an example here of spending at various levels against different ROASs. Just one thing to kind of touch on here, one really important point to note. Spending on Facebook and Google, So if you spend €1 on Facebook and you generate €10 in Shopify in sales, you are actually comparing apples with pears. And what do I mean by that? So for instance, if you got a bill from Facebook or Google for that €1 that you spent on ad spend, the bill is actually 123 if you're in Ireland. So it's €1 plus VAT, but the €5 or €10 that you've generated in Shopify is fully inclusive of that. So what you're actually seeing in Facebook is actually over-representative of what you're actually generating, because the revenue that Facebook and Google are reporting on is fully inclusive of that. So that's a really, really important piece to just dive into. And we will go into that in a little bit more detail as well.
That's a hallelujah moment for me, Thomas. I've spent a lot of time talking to marketeers about stripping out the VAT in reporting. So I'm glad to hear that this is something that you're focusing on.
Yeah, I mean, we've kind of done a break-even point ROAS on a product level within the StoreHero platform to kind of auto-calculate, including the VAT piece on a product level, so everybody can see it. It's kind of eye-opening. I've spoken to so many brands who weren't aware of this, and obviously you're started to worry about attribution and is it reporting my ads correctly, whereby there could be something staring you straight in the face that's 23% worse. Is it representative of a 23% decrease in what you're actually returning on your ad spend? So just being mindful of that is incredibly important. But just to my point here on how a high ROAS can often represent or that quest for a high ROAS can often represent a lost opportunity. So for instance, if you were a brand trying to say, okay, we're not actually going to spend any more money once we hit an 8 ROAS, you can see the absolute contribution margin that brand would have generated would be 14.5K. Now, obviously, once we start to increase the ad spend, that ROAS is going to decline. But for instance, actually the most profitable line here is when the business would have spent 10K, they would have reduced the ROAS from 8 down to 5.5. And the absolute contribution margin figure at the end of the day was nearly at 17K. So that's a good jump if you're looking at that on a monthly or a weekly basis.
I think this is the key to everything today. I think it's number one, understanding contribution margin, and number one, really understanding on a product level what is the optimal ROAS for your business.
For sure. And I mean, just even to that point there again, like, so if you then said, okay, I actually next month I've generated, this month I've spent 10K, generated 5.5, and I generated nearly 17K in contribution margin. Let's try and push that further. But what happens actually when we increase that from 10 to 12.5? The ROAS went down, and actually the contribution margin, even though we spent more and actually generated slightly more revenue, we were actually much worse off, because the absolute profit that we had left at the end of the day actually starts to dwindle. So we kind of get into a point of almost diminishing marginal returns, whereby you want to try and find that sweet spot. But once you find the sweet spot, as you start to spend more and more above it, it becomes less effective. Now, there is other ways to kind of get around that through site optimization, through bundling, through different mechanisms that we can do to actually optimize the site, so that even when we start driving more and more traffic to the website, that we can try and make sure that 4.5 becomes a 5, or becomes even just slightly below the 5.5 mark as well. But again, really important point to understand that if you are setting a target ROAS, that you understand why you're doing it, and that you're really just trying to optimize and find that sweet spot where possible.
Wouldn't be the first e-commerce person to go broke chasing ROAS, Thomas. So I think this is one of the lessons that we're all learning in the last 12 to 18 months, is that we're back into this. We're back into this understanding of ROAS at a deeper level. The only other thing I'd add is, for me personally, I just removed the VAT from almost all internal reporting. It's important to understand that like VAT, if you're a direct-to-consumer business, really only impacts your customer from a price point perspective. And then after that, it's almost irrelevant. And I know that it's built into Shopify and different places like that, but it's a red herring. And I understand that, a lot of the metrics will include the VAT, but for me, VAT has an impact on a recommended retail price point when it's customer facing, how much we charge the customer. After that, once you've figured out the price that you want to be setting from a customer's perspective, and where you want to be sitting in this kind of, let's say, amongst your competition in terms of how you're trying to position the brand, at that point you almost can forget about the VAT and work backwards. And that's generally been my approach. And I think key guys in StoreHero have done something quite similar, in that you're acknowledging that VAT exists and that it is reported on, but really when you're starting to look at the profitability, you're looking at it from an ex-VAT perspective.
100%. And it's just such a key piece. you can get blinded by seeing Shopify screenshots online all the time. But again, you really have to be mindful of that VAT implication as well.
And one of the key things that Store Hero that you offer is, so I would have always suggested to people that just do your own ROAS, take your sales, divide it by your marketing, and because Google will give you one figure and Facebook will give you another figure, but you guys in Store Hero are now supporting business owners with this type of analysis, which is great.
Yeah, one I suppose metric just to that point that we've introduced is your this kind of concept or idea of marketing efficiency ratio. So what do I mean by that? Essentially, it's your net sales. So yeah, we're getting rid of the VAT straight away. We're basically just dividing it by your total marketing spend and giving you a figure. So this is the ratio on how actually effective your marketing was. So yeah, you can just say, okay, I spent 1 and generated 4, and you have all the VAT taken into account. And we're not really listening to what Facebook or Google are saying in terms of what the purchase revenue, the purchase attributed from those platforms actually was. We're just really looking at it on a macro level.
Marketing efficiency ratio. I now know what I'm going to call it, at least. Very good. I'll have to update my reports. Thank you very much, Thomas.
No problem. Okay, another slide here is, I suppose, one that I just think is going to be imperative for brands to really try and succeed into 2024 and beyond, is that your finance and your marketing teams really need to start working together and actually understanding each other. And it's something we would have touched on earlier on at the start of the webinar. But I suppose why marketers need to speak finance. So like, if you're a brand owner and you're spending on Facebook and Google, again, often it can be seen as this black box. It can be seen as guesswork. We're going to try and increase, I don't know, ad spend from 3K to 5K or 5K to 10K or whatever it is. But really just trying to understand, I suppose, the contribution margin there, because as we've kind of alluded to, the days of easy ROAS are kind of behind us. Attribution issues have just meant that Facebook and Google are not as accurate as they once were in terms of what they could actually report on. So that, again, that idea of monitoring that contribution margin to the profit after your marketing spend is just incredibly important. So we're not asking marketers to become accountants, absolutely not. But the idea of really monitoring that profitability and margin perspective as these ads have got more expensive is just, it's a no-brainer. And I'd even say, go as far as to say it's an absolute prerequisite if you are taking your e-commerce brand seriously this year and going into next year as well. So really understanding that, okay, are you planning to increase your ad spend, and how has that margin held up after marketing spend over the last couple of months? What kind of guardrails have you in place? Do you know that the increase in marketing spend is it actually working? Is it not working? Have we overspent whereby the revenue actually might have gone up, but the profit after marketing spend is actually going down? And you really want to be mindful of those. That's obviously really important, but I actually think the opposite is even more important as well, in that if you are operating an e-commerce brand today and you are dealing with your accountant, and again, I kind of alluded to this earlier on, but if you are dealing with the local accountant, and for instance, you might be their only e-commerce client, okay, they'll understand the P&L that they get at the end of the month, but you really want to be speaking to somebody who actually understands the 1,000 different acronyms that we all work with on a weekly basis, because there's a lot. And again, in times gone by when ROAS was good, your accountants or your finance team probably didn't need to understand this kind of level of detail, and you probably would have had a profitable business. But like, your paid ad strategy is central to the profitability of your e-commerce business. So if you're taking advice from your accountant, just make sure it's somebody that actually understands e-commerce and understands marketing, because it's now more important than it actually ever was. And I just think you need somebody in-house to actually gets that world, because it's a different language. E-commerce and marketing it's a different language on its own. And yeah, I just think it's really, really important. Again, the best ones that we're working with are all really dialed in on this contribution margin figure. I'm sure you'll have a bit to add to this one, Richie, above all else.
I mean, it's been very interesting to see business owners pick up the phone to their accountant in the last. And again, I think obviously the trends you mentioned have started to push a bit of reality into the e-commerce environment. And I think it's just, a lot of it's just good business that would have existed outside of the online environment. So if you ran a shop in town, you would have understood you would have understood the nuts and bolts of your business in a fairly detailed way. And because of the heady days of the easy ROAS, I think a lot of people got away, or e-commerce entrepreneurs, without actually understanding their business in this sort of an in-depth fashion. So for me, it's just the reality of doing business is the reality of doing business. and it started to enter into this e-commerce environment a bit more. The couple of things I'd add to this is that really what we're talking about here at some level, at a very high level, is getting yourself a good P&L. And it's just an e-commerce P&L which separates out the costs into a different bucket and gets you to this contribution margin. And in an e-commerce environment, you should be looking at your contribution margin definitely monthly, but maybe weekly and even daily. And I know that that's something that StoreHero provides as well, whereby your software will reach into Shopify, it will strip out the sales from Shopify, it will reach into Google, it will reach into Facebook, and it'll build you a P&L on a daily, weekly, monthly basis. Is that correct, Thomas?
Yeah, that's it exactly, Richie. So we're really trying to just put as much profitability data out there as possible, and just make it as easy as possible for people. Because I mean, I was doing this in spreadsheets for years myself as well. But I suppose it really speaks to, I suppose, a fundamental issue that I see with e-commerce in general. And we all have this fascination with revenue-oriented metrics, and unfortunately, like a good e-commerce business is operating between anywhere from 12 to 18% in terms of net profit. So relative to the revenue the business is driving, it's a slim margin game. And to be optimizing everything purely based on revenue-oriented metrics can often lead to misaligned incentives for e-commerce managers or your digital marketing team or whoever else is really incentivized to hit certain KPIs within the business. So moving away from purely revenue-oriented metrics to more profit-oriented metrics, I just think is going to be key for brands to really just move the needle forward in the next couple of years.
I will say, in defense of accountants, there's more acronyms and TLAs and KPIs in the digital marketing space. It's almost incomparable. So it even catches me, who I've been looking at this stuff for years. I'll be sitting in a meeting with a bunch of marketeers and wondering, wait, that's a new one. What's this new one that's after coming onto the horizon? Some kind of attribution thing. But I will say that it's not a case that you need to get lost, and it's not, again, as you mentioned, about people needing to understand accounting, which is debits and credits and all that. It's really about nuts and bolts stuff. It's the fundamentals of your business and where your profit is inside in your business, and where your profit is inside in what you're selling, the products that you're selling, how much it costs and you need to sell it. So it's fundamental stuff. You can get lost in the KPIs, and you can get lost sometimes in accountancy speak. But really what we're saying here is that if you take the e-commerce business, you break it down into its fundamental parts, and you look at a P&L on a weekly, monthly basis, and after that, then you can dive into the unit economics of each SKU in terms of what you're selling. And it's kind of that in a nutshell as far as I'm concerned.
100%. One thing we've actually brought in recently was the order level profitability. And yes, it's really important to see your P&L, your business P&L, and your SKU P&L, but actually understanding order level profitability. First of all, it's really hard because Shopify says one thing, and then you have your on-post bill or your DHL bill, you have your 3PL bill somewhere else, and then you have transaction fees and so on and so forth. So you can plug that all into StoreHero, for instance. And now you don't want to see this every day, maybe you will, but popping in at the end of every week or every month and actually hitting the profit figure in the corner, the gross profit, and it's sorting. So if you have 1,000 orders, for instance, and you want to sort by most profitable, you probably have a good inclination of what those orders look like because they're the ones everybody wants to see. But actually the opposite side of that case, filtering or sorting by your least profitable orders and trying to actually understand, like, what's the genetic makeup of those orders? Why have those orders all been really unprofitable? Is it a case that, for instance, we don't have the margin on that product initially? Have we given a 20% discount and a free shipping threshold, and we've shipped the order to Germany where we haven't priced our shipping incorrectly? So a good business will be made up on a flood of really profitable orders going through the system. But often, and I see this time and time again, bad businesses they'll struggle due to an inability to spot a flood of really unprofitable orders going through the system because of the amount of variables that are actually on the order. If you're giving a discount, if you have a free shipping threshold, if you have a 3PL you're working with, you have transaction fees and so on and so forth. There's a lot to take into the mix in that you haven't just sold an item for €40. It's really hard to actually understand once you strip all of that out and VAT, what you're actually left with at the end of the day. And really starting to understand that, I think, is just incredibly important for a lot of brands as well.
I've seen it before, Thomas, whereby you can actually scale losses. So if you're losing 10 cents on an order and you're selling one order, okay, it's not a problem. Sell 1,000 of them, and suddenly you're starting to eat the profit out of the other products that you're selling in the e-commerce channel. So again, it's worth noting that you have to understand the nuts and bolts. But you're going to talk about VAT next, which is a hot topic, I think.
One of your favorites. Again, you kind of touched on it earlier a little bit there, but the implication on your VAT and your ROAS, and just kind of guiding line there is be careful. So your break-even ROAS, so the kind of how to figure that out, it's really important. And I suppose just a bit of context, I would have, during my time at Shopify, was talking with merchants, and some of them were achieving really good ROAS through COVID, and then obviously some of that subsided after COVID. I was speaking to one merchant one day who said, like, we were generating 12 ROAS throughout COVID. Now we're down to 6. My accountant wanted us to pull the marketing spend because it's only 50% effective. And I was I had an inclination it was wrong. So we kind of pulled out all the numbers and we actually stripped out all the VAT. And they were actually profitable. I think it was at a 1.8 ROAS, and they were generating at 6. But the accountant or the founder of the business had just seen the ROAS go from 12 to 6 and assumed it was unprofitable. But again, it was just based on a gut feeling rather than actually having data to back that up. So what I'd advise anyone doing or watching this webinar is like trying it. We have a break-even ROAS calculator on our website if you want to have a look at it, but try and actually plug in your numbers of some of your most profitable best-selling items and actually understand what does your break-even point actually look like on a product level, because you could be surprised in a good way or a bad way, but you could be really surprised, and it could give you a lot of opportunity to kind of push that product a little bit harder. Because just from speaking to so many brands, often the gauge for what we need in terms of ROAS can often be done on a gut feeling rather than backed up by hard numbers.
And this is, again, do you have the marketing problem or do you have an OPEX problem? It might be the case that the ROAS you're getting inside in this product is completely sufficient that you can continue to push, that you haven't hit this equilibrium of being able to push contribution, and that the issue might be somewhere in the OPEX. But I'll leave you to dig into the nuts and bolts.
Sure. So just the kind of the break-even ROAS calculator that we do have on the website. So again, your €50 that you see, for instance, if we look at the so we can see that the revenue there, we have to strip the VAT out first. So the actual revenue that we've generated is 4065 because we have to give that over to the government, and then we have all of our variable cost of goods in there. So our product costs, shipping costs, transaction fees, and any other costs, in which case here we've left it blank. So for instance, your total cost for this, total cost to fulfill this order is 1610. The revenue that you've generated is 4065. So we can work out there our gross profit, and then you can actually quickly see what that break-even point ROAS actually looks like on a product level as well. So again, this is done automatically within the StoreHero platform on a product level, but you can use the calculator there for free to kind of plug in your numbers and just start to understand what that might look like for some of your best-selling items.
Okay, some homework for people. They can log into the StoreHero platform and figure out their break-even ROAS. Okay,
so where are your problems or where are your opportunities in your business? So for instance, if you're not as profitable as you'd like to be, but you know that you actually have a high contribution margin, you probably also have high operational costs, and therefore your operational costs could be your problem. Like if you're generating, I don't know, 20K a month in contribution margin, but then you have 15K between staff costs, software, and rent, your net profit at the end of the day is only going to be your 20K in contribution margin minus your 15K in your operating costs. So your net profit is actually only going to be 5K at the end of the month. Kind of what you were alluding to there, Richie, as well. I do think a lot of e-com brands have probably had a bit of OPEX bloat, I suppose, over the last 2-3 years. That can come in many different forms. They can be difficult conversations, but trying to understand where is the problem, where is the opportunity that you're generating in the business, or what is actually the problem, because it can come in a multitude of different facets, really. Secondly, there we're looking at the low contribution margin minus low operating costs. You probably have a contribution margin problem. Really understanding and differentiating between these 2 points, I think, is so important. We're working with one brand recently, and for instance, they had the same staff on all year, and they're really busy, like a lot of brands in Q4. But the brand wasn't really profitable, we'll say, from June to maybe mid-September every year. And that often had a big impact on the profitability of the business at the end of the year. And we always had a hunch that the staff costs were probably, as a percentage of net sales, were quite high. Now, they didn't cut the staff bit or anything like that, but we actually understood that we pushed a hell of a lot harder on the ad side of things. The ROAS that we were generating actually dropped by nearly 50%, but the absolute contribution margin was much higher. Whereas typically for those months, the brand they had about 15K in operating expenses, but the contribution margin was kind of fluctuating from, I don't know, 12 to 18. So largely kind of break even for those couple of months. So we really increased the ad spend. The marketing efficiency came down, but we actually got the contribution margin up to about 20K for those couple of months. It just meant the business was much leaner. Obviously, revenue went up, but the profit at the end of the day, even though we massively increased the ad spend, just meant that the business was much more profitable throughout those typically quieter months of the summer as well.
I think there's a conversation there that might be had in terms of what you can outsource as well. So some businesses might have taken the decision to handle a lot of the e-commerce marketing internally, and that probably looks like somebody or a whole team of people working in marketing. So the question might be, well, what is it that you might be able to outsource? The other area that's worth looking at might be, just as you've highlighted here in the operational costs, is this last mile stuff. Some people might be holding the fulfillment inside in the business. And again, there's a question of, a lot of people would perceive that you're adding value in terms of the ability to ship and customize the boxes that you're sending to customers or wherever they might be. And I think there's just some decisions to be made there in terms of, what piece of it do we keep as a wage cost, because it's very important to us. We want the IP, we want to build a team and build a culture, versus what could we get from outsourcing parts of this to maybe an agency. And then again, on the fulfillment side, what would it look like to outsource to a 3PL in terms of the cost of that versus what we can do ourselves? So there's some questions there's some areas to be looked at there for sure.
Definitely. I mean, if you're a brand that relies heavily on Q4 and you have the same staff on all year, are they unnecessarily quiet for 9 months of the year? And kind of to your point there, would it make sense to potentially outsource that to a 3PL that just scales up at busier times of the year instead of having a high base for the whole year that isn't going to be used as effectively as it could be?
Exactly.
Okay, so yeah, we're typically saying anywhere from 18 to kind of 25% is a good barometer for what you should be looking at in terms of your operational costs as a percentage of net sales. You want to be monitoring your staff costs, looking at your software costs, your costs. Have you got loads of apps added to your Shopify account over the last couple of years? Are they all actually adding value, or are they just adding to your bill at the end of the month? So just kind of regularly maybe going through a little bit of an app audit to really just comprehend what's moving the needle for us, really. And just to that point again, looking at weighing up, does it make sense to work with a 3PL to fulfill our online orders versus doing it in-house? Like, are we employing a warehouse and a team of staff to manage a level of orders that isn't really sustainable? And it could be an interesting point for brands to even understand, if you didn't have a warehouse or staff costs, like, what is the pick pack cost? What is the cost on an order basis to use a 3PL? And even do the same then for what you've actually done over the last year in-house. How many orders have you fulfilled versus what is your warehouse cost and your staff cost to fulfill that number of orders? If there's a big disparity between the numbers, you probably have a lot of room to potentially look to optimize that a little bit as well.
This is great. Yeah, the only thing I'll add is that if you haven't done it already, it's a very useful exercise to do, to just press print and print out all your software costs, and then ask yourself the question: are we on the premium package when we had 10 people working for us 2 years ago, and now we're down to 5 people? All that stuff you can actually just, so like, for example, sometimes when you're looking at operational costs, if you're looking at this net profit 18 to 20%, a lot of times when you're doing reviews of operational costs, it's a 1% gain that you're looking for. So you're scraping out the 1% on the cost side, and it has a massive impact on your net profit. So it could be something to consider. And it's not necessary to do it every month, but even once a quarter, it's great to do that type of a deep dive.
And just to highlight again, I suppose that every euro you save in operational costs adds to your net profit. Like, whereas if you generate an extra euro in sales, that's not an extra euro to your net profit. So again, it's really important, please, to understand that if you do have a lot of operational costs and you feel like it could be bloated, trying to scale that back or just make it a little bit more efficient will just drastically improve that bottom line figure, which is just... This is
your dad speaking now, and it's that the accountant side of you kicking in.
This is why I had to justify every single expense.
Oh, very good. Yeah, it's amazing sometimes people don't quite understand the importance of saving that euro on the OPEX, but yeah, I'll leave it to you've got more advice for people here, I think.
Yeah, so that kind of was, we'll say, the last slide there was kind of touching on, okay, we've good contribution margin, but we have a really high OpEx problem. So the last slide was kind of touching on this. This slide kind of touches on the opposite, where we actually have low contribution margin, low operating costs, but we also have low contribution margin, and therefore the business isn't going to be that profitable either. And how do you look to fix that as well? So channel mix, we might dive into that again in a second, but looking to kind of continuously deploy new creatives, continuously experimenting with those, shop around to improve your margins, not just on your product costs, but your suppliers. Try to improve your margins or your terms with your shipping carrier, your 3PL, transaction fees, and so on and so forth. And again, really looking to continue to scale spend only if that contribution margin figure is going up. If it's continuing to go up, continue to spend. I often speak to business owners who don't want to give Facebook or Google any more money, but if you've worked out that there's a good ratio there in terms of what you're spending with them and what you're getting back, as long as that number keeps going up in terms of what you're getting back, just continue to scale that up and up, because it just definitely makes sense to do so. In terms of channel mix again, so obviously the landscape and online advertising has got that bit more expensive as well. So brands are often looking to move the channel mix towards often retail or wholesale, or often to marketplaces as well. I know this is kind of something that we were touching on before the call, Richie, as well.
Yeah, it's been kind of interesting. Definitely, if we go back a certain number of years, a lot of people were focusing just on the e-commerce, direct to consumer, straight to your website, and now we're starting to see that the value of possibly having a real good presence on some of the UK marketplaces, especially if they're niche oriented, is really, really good. But and also your old school bricks and mortar. So there's nothing wrong with a sale that comes from a partnership with a number of shops or working with a distributor. And I think it's worth considering if your product has a suitability for offline retail in addition to your e-commerce offering. Now, some products won't fit that category as well as others, but there's a lot to be said for one invoice a month to a distributor who's selling into X number of hundreds of shops versus the hard yards that is required to be successful online. Now, they're both great and they're both necessary, but I would just throw that out there and say that sometimes we have to see that there's a lot of shops in Ireland and across the world in different countries, and a good partnership with a retailer, it can often be something to consider if you're finding that it's hard to maintain profitability by just looking at your direct consumer channel online.
Absolutely. And I mean, it can often almost be a marketing mechanism whereby you're not abandoning your direct consumer business, but if you're going into physical retail or you're going wholesale through a distributor, your product is going to be seen a hell of a lot more as well, and that will all boats will rise in terms of the business. You will get more customers online as a result of that as well. So
now the previous thing that people would say is that because the ROAS was so good, like why would I work with a retailer because I'm giving away margin? But obviously, as the ROAS has started to get squeezed and the margin has started to get squeezed online, it's starting to make sense to look at retailers, especially if they can do the volume. But yeah, it's something to consider if you are somebody whose products would suit that type of an environment. And again, the marketplaces are starting to. Our Amazon, for example, has continued to grow significantly, which is again squeezing footfall of getting people direct to your website. So what does it look like to be successful on Amazon? And as mentioned, the other marketplaces that might exist in Ireland and the UK. But yeah, excellent. This is all great tips for people, Thomas. Thank you very much.
No problem at all. A couple more bits, I suppose, on how to use contribution margin in terms of how to improve your business. So again, looking at your promotional strategy, just really discounting responsibly, I suppose. And what do I mean by that? Like, don't be just going all out with a 20-30% discount to try and increase your sales. Try and figure out, is there a good mix of products that we could potentially bundle together? How are we looking at, we'll say, products with good margin in terms of our site merchandising? Are they front and center? Are they coming into our email campaigns? Are they front and center of our paid marketing campaigns? On the opposite side of that, are we promoting products? Are we putting big ad budgets behind products that maybe don't have the margin mix there? Do we think about how we're looking at discounts in relation to, we'll say, the cost to acquire a customer? All those things are really, really important to take into account. And obviously really looking at that last piece there in terms of, I suppose they're all quite interlinked, but the optimal product mix and efficient fulfillment there as well. So like, again, to that point I kind of touched on earlier, if you're selling something for €50 and you're going to give free shipping on that, and you've given a welcome 10 discount as well, you are on a 20% sale without even realizing it as well. So if you're then going to go on a 20 to 30% sale, just really make sure that you're doing it for a reason and it's strategic to the business and that you have a goal set up in mind. Just really try and refrain from just going on big sales just to increase revenue, because you could be just driving a volume of unprofitable orders to the system, which will increase your revenue, but is really just a vanity metric at the end of the day.
Yeah, I think definitely just on the discounting one is just to really understand what is the cost of discounting it, and to consider it as you would consider any other cost in your promotion, any other cost in your unit economics. It's built in there. It can be sometimes, like I know there's on Shopify, for example, I've yet to figure out a smart way of doing this. I think there's some apps that during Black Friday, Cyber Monday just drop all the prices on the site, and how you're reporting on those discounting and how that's built in is something to be considered. But it's very important that you would have an understanding of what percent of understanding the trends of discounting in your e-commerce channel. So for example, what percentage of discount did you give away in September 22 versus September 23? And then to look at it during quarters as well, and then to look at it on a unit basis, and just understand, are there any trends in there? Have we reduced our ad spend, but we're giving it all away on discounting, or vice versa? And just to have some kind of measurements in there in terms of what is discounting working for you and what's happening over time, I think is very important.
Extremely. Okay, so question we consistently get asked, like, what should I be monitoring? There's a million different KPIs to be looking at every day. Again, I'd be really conscious, just really look to optimize your business and KPI yourself on profit orientated metrics as opposed to solely looking at revenue. We're working with businesses who are doing less revenue this year but have really massively ramped up the actual bottom line of the business at the end of the day. We've leaned out some of the operational costs. We have improved the margins. We've kind of reduced discounting, thought about better promotional and bundling strategies. There are better ways to improve your bottom line that don't necessarily mean improving your sales. Track your contribution margin and do it daily. Really, really important. Your ad spend is going to be such a massive determination in how your business performs. You want to make sure that you're spending at that sweet spot as much as possible. You also really want to be careful that as you start to increase your ad spend, that it's actually adding extra incremental profit to the business, and that you're not adding extra ad spend, your revenue is going up, but that bit that's actually left for you at the end is actually gone. So really just making sure that you're tracking that contribution margin piece daily. Also do it obviously weekly and monthly as well, but I will get into the habit of trying to look at that daily. Think of your business profit first. Think of it like a bill that almost needs to be paid and work backwards from it. You'll have your net sales figure. You know what your kind of average cost of goods margin is, and what is the percentage, net profit percentage that you want from the business. The bit that's left, that's your marketing budget. That can only be your marketing budget. And then look at, is that applicable? Is that actually realistic for my business? If it's not, we might really need to start looking at, again, our bundling strategies, our trying to optimize for margin in different components of the business. We might need to optimize our operational expenses and so on and so forth. But again, trying to think profit first where we can, I think, is just incredibly important.
Yeah, this is excellent. I think one of the things I'd say is that a lot of e-commerce business owners would be like bootstrapped. What that means is that you don't have oodles of investment in the bank account to spend, and so it is the case that if you're not running your business profitably, that it's not going to work out, unfortunately. And the other part of that, I would say, is that you have to understand the impact of stock on cash flow. And what that means is that you can't run to the red line in terms of how you're running that business from a cash perspective. You need to sit on some kind of a buffer of cash. And what I would say for that is that, sort of just from my 2 cents to wrap up here, is that, as Thomas has said, you need to understand your margin per channel, per unit. I've mentioned possibly diversifying away from just completely direct to consumer, if it makes sense for you. On the cash flow side, I usually tell business owners to try and keep 3 to 6 months of operational costs as a rainy day fund. So again, if you look at the e-commerce environment, there's a seasonality to it, whereby people typically will make somewhere like 40+% of their annual revenue will come in Q4. And what that means is that there's going to be lean times from January up until September, let's say. And do you have the money to buy the stock? Especially if you look at the COVID period where the guy tried to do a 3-point turn in the Suez Canal and suddenly all stock from around the world was backed up by about 6 months. And for a lot of people, when you increase the lead time on the stock ordering, suddenly you need more cash because you're buying more stock. So it's very important, if you are an e-commerce business, is to understand the impact of the seasonality of your sales and the lead time on purchasing of stock, because if you've got stock outs, it's going to impact your business in terms of making that sale. The last thing I'll say to people as we're moving towards wrapping up here is just understanding the impacts of that. So if you're an Irish business selling to customers online, it's 23% on the top, and that's relatively straightforward. If you're selling to Europe, there are rules around, what VAT you charge, and you should speak to your local accountant about that. And the last one then is if you're selling internationally to non-EU countries, essentially there's no VAT, and that includes the UK. But it is the case that if you are selling into the UK, it might be necessary for you to register for a UK VAT number. So, and remit that 20% that's owed to the HMRC. So that's just a few points I said I'd outline, typical things I see in e-commerce businesses that people haven't quite given enough thought to. But yeah, Thomas, I'll move towards wrapping up here, but I just want to say thank you very much. It's been a really interesting conversation. If anybody's got any questions, feel free to throw them into the YouTube chat. Feel free to reach out to me or Thomas on our respective websites, which is Around Finance or Store Hero. But yeah, Thomas, thank you very much for your time today. Any final thoughts before we move towards wrapping up?
Yeah, I mean, look, there's still so much room for opportunity out there. Might have sounded a bit doomsday for some people out there, but there's so much room for opportunity out there still. I just think, just to kind of, I suppose, one final point, marketing and finance need to be in line with each other. That's probably the main point I would try to hammer home with everyone here today. Having those two functions in line with each other is going to be the biggest determination of whether you're going to really ramp the business up to the levels that you wanted to get to over the next couple of years. Having those two in line with each other is almost a superpower in e-commerce today, to be completely honest with you.
I agree. And again, just to echo what Thomas said, it's not our intention to be in any way doomsday merchants. It's just really all that's happened in my view is that a little bit of madness has got, a little bit of air has got let out of the bubble, a little bit of the air has been let out of the bubble. And if you think about it, there's an opportunity in that. If you are an e-commerce business owner that understands your metrics, understands the fundamentals of your business, you've got a good product and you listen to your customer and you get a good partnership in place with a marketeer and a finance person, the opportunity for success remains. All it means is a lot of the kind of madness has dropped out of e-commerce, and we're now back into people that are building success. People who are building businesses with the fundamentals in place are going to do very well and continue to do so. But we'll drop off. We won't run over time, Thomas. Thank you so much. I really do appreciate you taking the time and coming on and giving us your thoughts today. And yeah, I'll talk to you again soon.
Perfect. Thanks very much, guys. Really enjoyed it.
Thank you to everybody. And we'll add this onto our YouTube channel. We'll email it to everybody, and we'll stay tuned for another webinar, hopefully next month. Thank you all very much. Thank you again, Thomas.
Cheers.
Good luck. See you. Bye-bye.